Hi, I'm Sherry Grabeau, the Chief Executive Officer of Guided Choice, and this is The Financial Wanderer. So what is a mutual fund? Well, interestingly, you can just kind of use the name to figure out what a mutual fund is. Mutual just means a group of people that have a mutual goal in mind. And a fund is just where you put your money together. So think of it as a bunch of people dumping money into a bucket, and then they take that bucket of money and they go to an investment professional and say, hey, we'd like to hire you to invest our money. Now, why would anybody do that? Well, there's good reasons to pool your money together. And one is the larger the amount that you're investing, the lower the per trade cost is. So it's less expensive to invest when you invest larger amounts of money. But not everybody has large amounts of money available to themselves to be able to invest on their own. Secondly, you may not have the time or the aptitude to do the investing on your own. So for example, you might not know what stock or what bond or what kind of investment to buy. And so if that's the case, hiring a professional makes a lot of sense. Now, many people believe that they're investing in a mutual fund and they don't pay anything for that. And some of that's just because you'd have to read the prospectus, or as we like to call it, the fine print, in order to know how much you're actually paying when you go hire that investment professional. It's usually done as a percentage of the money that you invest. So, for example, it could be anywhere from, let's say, 0.04% of your money that you've chosen to invest up to well over 1% of the money that you've chosen to invest, which may sound like a nominal amount of money, and it is when you have small amounts you're investing. But as you invest more and more, you'll see that the investment costs are higher and higher for you. Still, it'll make sense to hire an investment professional rather than you having to do it on your own. Now, another thing to understand about mutual funds is typically they all have a written specified goal. And what that goal is how they'll invest. So it would define whether they're going to invest, for instance, in stocks or bonds or maybe cash type instruments, whether they're going to invest internationally or here in the US. So they'll tell you what they're expecting to invest it in. And that's important to you because you need to understand the risk that you're taking. Now, the more specialized the fund is, then typically the higher the costs. So some funds are less expensive, like cash, because it's easy. Low risk, lower opportunity, they're easy to choose those investments, and so therefore a lower cost. But take something sophisticated like emerging markets in the international marketplace. And those would be countries that don't have a developed economy yet, and that's highly specialized. So you might pay over 1%, in fact, maybe even close to 2% of the investment in order to have that professional money management. So depending on the sophistication, that will drive cost. It also drives risk. Higher risk investments will tend to have a higher expense. The other thing to note about mutual funds is they can go as specialized as I mentioned, let's say you invest in stock funds in the United States. Well, it could be small companies, mid-sized companies, or large companies. And how do they usually define that? Well, the S&P 500 would be the 500 largest companies in the United States. So if you see a fund that's investing in large capitalized companies, that would be the S&P 500 that they're choosing from. But let's say it's mid-size. Well, after you took the first 500, now take the next 400. And that would be the S&P 400. And that could be the mid-size companies that they're choosing investments from, the stock to buy and sell. Lastly, might be a small cap that's going to have the highest risk, and small cap would be the next 1,000, the Russell 1000. So depending on what they're investing in, that tells you about the risk. It'll also kind of give you a good idea of the cost. Again, higher risk, typically higher costs. The other way they can specialize the fund is to go into what we would call sectors. Sectors would mean it's investing in one particular sector of the economy. So maybe you have a high-tech fund or you have a biotech fund. And they may even go further and say, okay, this is a small cap tech fund. This is a large cap tech fund. So as you can see with mutual funds, you can choose how much risk you want to take. You're just pooling your money with other people and hiring an investment manager. That's the simplest way to see it. Now, the other advantage of mutual funds, which oftentimes is overlooked, is that they are what's called an SEC, Securities Exchange Commission, so that's a government entity, and their SEC 40 Act, which just means that the act was passed in 1940. It's a 40 Act company. What that means is the mutual fund itself that you invest in is an actual company. So you're investing in that company. They hire the mutual fund manager for you. So for example, you invest in Contrafund at Fidelity. Well, Contrafund is the company, and they hire Fidelity to hire the fund managers to manage your money. That's technically how it all works. You can read all that information in the prospectus. Again, the fine print. The key thing to understand, though, is you're pooling your money together. You're choosing a type of mutual fund. It's going to tell you what its objective is in the prospectus, and you would want to know what the objective is to know and understand the risk that you're taking. And it will have an expense ratio. You do pay for mutual funds. Oftentimes people think they're free because when they see the rate of return that they have, it already subtracts out that expense ratio. So it's the expense ratio, that's the percentage of your money that you are paying for that professional management, as well as all the administration side of it, the accounting, the trading costs, the trustee costs. All those costs are embedded into your expense ratio. So when you go to invest in your 401k, or possibly on your own in a retail brokerage account, mutual funds provide an excellent opportunity to have professional management at a low cost.